Hello, everyone, and thanks for joining us today. Welcome to GreenUp Wealth Management's quarterly market update for the first quarter of 2025. My name is Tony Schmidt, and I'm the CEO here at GreenUp Wealth Management. And I'm joined today by GreenUp's Chief Investment Officer, the head of our investment committee, Daniel Grulich. Daniel, welcome, and thanks for joining us today.
Thank you for the introduction, Tony. I'm excited to be here, and we certainly have a lot to talk about.
We truly do. It's very volatile in the market. And those are some of the things that we're going to dig into today. And hopefully, at the end of this, everyone feels informed and understands exactly where GreenUp sees things and what we're doing to help our clients succeed moving forward. So, without further ado, let's dig right on in here. Dan, just mentioned the volatility. Why are we seeing this turbulence in the stock market right now?
So there are lots of terms that we throw out in finance, and one of them is a correction, Tony, and that's exactly what we're experiencing right now. That's when you see the S&P 500 hit a high, and then it drops 10% from its heights. And if you look at the chart, it's just showing you the performance of the S&P 500 index over time. And at the very far end of the chart, you see a nice dip down, which is what we're experiencing right now. A lot of that is happening because of some of the new policies in the administration and how the market is interpreting them, not necessarily negatively or positively, but the market is very uncertain with the path forward. So it's something that we see quite a bit, and we just have to decide, is this something that's normal or something that's abnormal, and how are we going to act upon it?
Well, we all know the markets, they like certainty. And there is a lot of uncertainty out there. So it certainly makes sense as to why there's been this volatility. And it's something that we've been talking about on the past 3 or 4 webinars, that this volatility existed and was going to be coming, and something that we've been ready for.
Exactly.
So, Dan, with this volatility, with this significant pullback in the market, should our clients be worried about a recession?
And that's really the appropriate question to be asking right now, Tony. So at GreenUp, the way that we go through that answer is we'll divide it up into two portions. One, what has happened historically? Is this normal? Is it abnormal? Should we be worried? And two, what is happening right now? So if we look at history, this chart shows you a yearly performance of the S&P 500. And then if you notice, there's little red dots underneath each year, and that's showing you the maximum drawdown that has happened in that year, or the maximum amount of pain that an investor would have felt owning stocks in that year, even if they ended positive. All I would say is that if a correction is a 10% drop from its heights, that is not an abnormal number to see in the market. You usually see a correction once every year, about 1.2 times every year, Tony. So although I'm not happy to see a correction, this is not fun to go through, it is something that we do see routinely, and we're not yet worried about a recession, although we are watching that.
So, Dan, that's great to know. And we're talking about individuals. We certainly understand, and we continue to talk about, that the consumer is the driver of everything. The consumer is concerned about a recession, but let's take a step back. Because I keep hearing mixed signals on this. How is the consumer doing at this time?
And Tony, the reason we focus on this so much is 68% of our economic growth is determined by the consumer spending money. So if the consumer's in a healthy spot, generally the economy is doing well, even with situations like tariffs. So what I will also say as a caveat is things are changing by the moment, which we are looking at. But if you look at where we started before all this volatility hit, you saw a pretty healthy consumer. If you look at the chart attached, you're looking at two metrics. One is showing you how much wages have gone up with the consumer. That's at roughly 4%. That's fantastic. Well, what do we want to compare that to? We want to compare that to the cost of prices, the cost at which prices are increasing today. And that's the bottom metric. It's showing you how much inflation there is. As long as wage growth is above inflation, you should continually see the consumer be able to buy more and more goods. And that's a positive. That's where we sit right now, Tony. That could change in the future, but that's where we sit right now.
Yeah, that's a pretty significant delta to see Yes, cost of goods and services are going up, but there's a more significant rate that it's going up on the on the wage growth for the consumer. So that's fantastic to see that spread.
Mhm.
So Dan, as we're continuing to talk about individuals and people, because it's certainly easy to get caught up in a lot of the data, and we are going to let data drive decisions, but we also have to look at individuals. And the work that Doge has done inside of the government, there's been a large number of layoffs. How do these layoffs within the government in really impact the markets and our client portfolios?
It's never fun to hear the news, Tony, when you're talking about the government looking to lay off 600,000 to 800,000 people. That's a huge number. But I think when I look at the market, I have to ask myself, honestly, is that a huge number? And the answer right now is no. If you look at the chart in front of you, it's going to show you really two measurements. One is the total number of job openings that are out there right now. There's 7.7 million job openings currently. The second piece is how many unemployed individuals are there that are looking for jobs, and there's 7.1 million. So there are 600,000 extra jobs available in this particular economy that we're in. And with that amount of buffer, I do think that you can absorb some government layoffs. Now, again, if people are worried about tariffs and what's going on right now, we're going to be keeping a keen eye on the job market, because if jobs stay and we continue to have opportunities, we're going to get through this just fine. If we see job destruction, that's where we'll start to worry about the economy. Right now, again, just like the consumer, the job market is in a very good spot.
Again, another positive, right? And when I say positive, um, how the numbers are looking, big picture. As you mentioned, it's always horrible to hear about folks losing their jobs. But again, we do have to step back and look at the numbers and what is the data telling us? Because especially during times like this, it is very important to be disciplined
Mm-hmm.
and follow the data as far as here's what the current environment is, and this is the particular way we need to navigate these markets as well.
Exactly. It's really what makes someone a professional investor, Tony.
There's no doubt about it. And as we're talking about investing, we all know at the end of the day, corporate earnings are what's going to drive the market. And there's a difference between the economy and the stock market. So many times we look at them as the same animal, but it's just not the reality. There is a
Mhm.
difference between the two. So let's talk about corporate earnings. In this environment, are companies still growing?
Right now, yes. And part of the reason we focus on corporate earnings so much, Tony, is that it's really difficult to have wage growth and job opportunities if corporations aren't doing well. It really should be a symbiotic relationship. I know we say that over and over again, but that's really the hope in a positive economy. But you mentioned one point. We're focused on investing in the market, not the economy. And so when we look at the market, you can see a very distinct relationship on the chart. It's showing you in the blue S&P 500 earnings growth, and then in the black, the price of the S&P 500 index. And if you noticed, when one goes up, the other goes up. When one goes down, the other goes down. And it may not be direct, but there is definitely a trend here. So if we look at where corporate earnings have been, and honestly, I've been a little bit disappointed that you haven't seen more coverage on this. Q4 2024 corporate earnings just finished up. They came in at a whopping 16.5% earnings growth year over year, Tony. We were expecting 15%, and the average that you see is generally around 7%. That was hitting the ball out of the park. Again, things will change as time goes on, but we are starting in a very positive spot from an economic and a financial standpoint.
Well, it's good. It sounds like that's a great foundation.
Mm-hmm.
And we've talked about some of these foundational pieces, both, with the consumer, with wages, and now corporate earnings. Let's pivot just a minute and talk about interest rates because interest rates remain volatile. And it's something that is getting some coverage currently as well.
Mm-hmm.
But they almost seem to be meandering a bit, not exactly sure of where they want to go. So, how do bond yields truly affect the markets and the economy?
And Tony, this is kind of the three-leg stool that I see in the economy. You have the consumer, you have the corporation, and then you have borrowing rates. And whether we like it or not, our borrowing rates as consumers are directly tied to the US government's borrowing rates. So if you look at the current chart, you're going to see a representation of the yield curve in three different ways. And all that means is it's a visual representation of what the government pays, of how much the government pays in interest on its bonds by maturity. And the one thing that's noticeable, because you're looking at the black to blue line is the latest yield curve. The orange line is from last quarter, so about 90 days ago. And then the yellowish line is from 1 year ago. In every single one of those scenarios, you have short-term rates being at the same or higher than long-term rates. And I guess why the consumer cares about this, Tony, is if you look at the 10-year treasury, which sits right around 4% today, you generally will see mortgage rates be about 2% plus that. So if the 10-year treasury is at 4%, mortgage rates tend to be about 6%. And if you can lower that down, that should actually speed up the real estate market a bit in the US, which has been very stagnant for the last 3 years.
Wow. Yeah, I mean, you can definitely see where um, my comment around the meandering is going. It's an interesting journey, but as
Mhm.
interesting as yield curves are to all our clients, let's talk about the 800-pound gorilla in the room: tariffs. At GreenUp, we're never going to hide from the difficult conversations, and
Mhm.
this is one that is definitely not hiding behind a bush for anyone right now. Dan, how are these tariffs going to affect clients' portfolios?
So tariffs is never a fun word to hear when you're looking at markets, because we've been taught since college that if you have free trade, that's generally the route to prosperity. But I would also say, Tony, tariffs are not an abnormal part of the conversation when it comes to trade. I mean, they've been around only since about 3000 BC. It's You could argue they were the first economic trade tool used. Um, when you look at the chart, I think we see a couple of things that we try to take in mind at GreenUp. One, the chart shows you historically what the average rate of U.S. import, what the average tariff has been on U.S. imports. And as you can see, we're at historic lows. And even if we go up to where the proposed tariffs are, we're still at lows compared to where we have been in the U.S. So in other words, Tony, we've seen this before. It may not have been a fun experience sometimes when we've seen it, but we've seen this before. But when I think about tariffs and what we're seeing right now, I think of the fact that we've seen economists change their opinions by the day within this correction. And there is a lot of uncertainty that we don't have the answer to right now. And that's why we focus on process, Tony, with our investments. We have a process of being diversified and basically indicators that tell us when we should be looking to take on risk or when we should be looking to be conservative. So yes, I see a lot of uncertainty within tariffs, but I also understand that we've been here before. They're measurable, and if we have a process, we can make our way through this journey.
That's such a good point. And I think when we really step back and look at things here, tariffs have become a buzzword here over the last several months or during this last election cycle. But this chart shows tariffs are not new.
Mm-hmm.
Tariffs have been in place for years and years and years, right? As we look at this chart, it's throughout history. And so tariffs are not new. They're something that have been on. And of course, I'm not going to say that they're not at a very significant and high rate and have been increased very quickly. They absolutely have. But the fact that there are tariffs is not new. It's something that we expected and
Mm-hmm.
we're fully aware of, and we're managing to this situation. So at GreenUp, this is one of the front and center pieces of things we're looking at and evaluating. And as you referenced, Dan, it's a key point on why diversification matters. It is
Exactly.
crucial to maintain diversification with a proper risk adjusted asset allocation at all times.
And just like we've had tariffs in the past, Tony, we'll have tariffs in the future as well. So this will be something that we'll have to deal with on an ongoing basis because it's part of trade.
But Dan, let's build on that because we were fully aware of what was going to happen, maybe not the rates and the percentages and everything else in the countries, and no one was. However, we haven't been asleep at the wheel at GreenUp, and specifically within the investment committee. So, talk to us about the changes that GreenUp has made as a result of this market turbulence.
And this is where process really makes sense. So unfortunately, we did start seeing an expensive market with high expectations, and then a new administration coming in and possibly having some economic changes. And experience has told me, Tony, that that's just going to show that we're going to see volatility in the market. I don't know that I would have expected as much volatility as we're seeing today, but we were definitely expecting volatility. When you look at the chart, it's going to show you why we've decided to take the path that we have. So the chart shows you in the blue is S&P 500 returns per year, and then in the orange right next to it is the the Barclays U.S. Aggregate Bond Index, or a representation of the U.S. bond market returns. And if you notice, there is literally no year, well, maybe one year, where they're the same. They're always divergent from one another. And when you have times of a lot of volatility, Tony, you should generally be making sure the portfolio is still on track. So at GreenUp, we do have two indicators that we look at when there's volatility. We will, one, position the portfolio for where we want them to be at the beginning of the quarter. But if during that quarter you see the S&P 500 drop by 10%, we will go into the portfolios, do trades to make sure that our balance between stocks and bonds is correct, because that amount of volatility would have pushed it off target at that point. So we did that about 2 weeks ago when we first hit a 10% down in the market. The second piece is if we start to see the market go out of whack, and for lack of better words, we're outside of the 95% confidence level of where statistically the S&P 500 should be, Tony, we're also going to revisit the risk in the portfolio as an investment committee and decide if we want to take on more risk. That's the equivalent of you're in a car or a traffic jam and you're not at the beginning of it. You can actually see the accident and the highway is open in front of you. So when we see uncertainty with tariffs, we will rely on our process, which has helped us out historically.
And Dan, that's great insight. And I think there was a lot of jargon and data points in there. And what I hope everyone on this webinar is understanding is we're not asleep at the wheel. And we are always looking for opportunities to protect, preserve, and participate in growth for our clients' money. And we just have to be eyes wide open, because there's times that the market is going to give us a lemon, and we're going to do our very best to make lemonade. And it's not for the 3 months or 1 month ahead. Sometimes it's for the 6, 9, 12, 18, 24, 36 months ahead.
Exactly. A long-term view, it makes investing in these volatile times much easier.
So as we do look ahead, obviously a lot's changed here in the first quarter of 2025.
Mm-hmm.
What is your outlook for the rest of the year? Are we looking at smooth sailing, or got to keep the seatbelt fastened like the pilot had talked about on my flight in from New York middle of the week when they said, buckle up tight? That made me feel great.
So, Tony, at GreenUp, as you've seen, we don't try to forecast where we think things are going. We do have to have an opinion on where the market is going, but we are very reactive. We try to react off of data and data alone. And right now, when you look at the data, again, I want to be clear that this could very much change in the next couple of months, depending on what happens with tariffs and within the economy. But if you look at everything combined, from Doge to tariffs to immigration to taxes or deregulation, and you put it all together, there have been many, many economists out there trying to figure out, well, what actually is going to happen. So if you look at the chart in front of us, you see multiple measurements, but I want to focus on the top three. It's GDP growth, which is gross domestic product, or how much the U.S. has grown or is expected to grow from an economic standpoint. CPI, which is basically an indicator for inflation, and then the unemployment rate. And although 1.2% GDP growth, or 1.5% or 1.8% GDP growth is not something that you write home to your family and brag about, it's not a recession. It's a slow growth market. And if you combine the inflation metrics and the unemployment metrics with that, economists are expecting us a slow growth based market. They're not expecting a recession right now. Again, that could change, but right now the market is still moving in an upwards trajectory, or the economy is still moving in an upwards trajectory.
Yeah, it's good to see that as, as a backdrop and again, as a foundational piece. But although these are good things, Dan, as an investor, when we're dealing with significant volatility or turbulence, how are we supposed to stay calm and manage the emotion? Because last time I checked, we can't go and spend negative money.
Correct. If you find out how, please let me know.
No
I
doubt.
do think that this comes into play for why we chose the investment strategies that we did. I mean, asset allocation and diversification are not sexy strategies. They're not ones that over the last couple of years we've heard people write home about saying, thank you so much for the performance in this. Because yes, the S&P 500 has done well, but you also invest in mid and small cap companies in the US. You invest in international companies, both developed and international. You have thousands of investments here. So what I would look at is I would say, trust the processes have been around for 100 years. Really comes from asset allocation comes from a Nobel Prize winning philosophy of modern portfolio theory. And Tony, what that says is that if you put assets in two different investments as opposed to one that don't, and let's say those two different investments don't work the same, that you can get better performance for less risk. And so the other nice thing about that is if you look at asset allocation over a long period of time, you can tell that 92% of your gains or losses come from the percentage that you choose in stocks, bonds, or cash. Not anything else, just the amount that you have in stocks, bonds, or cash. So in other words, we chose a proven risk management strategy that will get through these types of markets. And that's one of the times where I really appreciate diversification.
Yeah, there's been people over the last few years that have been cursing those darn bonds and why do we have them in portfolios? It's dragging return.
Mm-hmm.
Well, it's truly for times like this so that it is as one area might be struggling, another area is working, right? If you have one flat tire, you're not going to go deflate the other three, right? We want to keep the other ones turning and pulling us through. So I think I
Exactly.
appreciate you bringing that up, and that is the cornerstone of our philosophy is asset allocation and diversification. And it's times like these that it really rings home on why it is so important for us to keep a properly diversified portfolio.
Mm-hmm.
So, Dan, we've covered a full gamut here, but let's take a few minutes and hear directly from our clients. So, as usual on these webinars, we've been very fortunate. Our clients are incredible and they've submitted some questions to us. So, for those, all of you that submitted some questions, thank you. We know your time is valuable, but if these questions are on your mind, they're certainly on somebody else's mind. So we appreciate you sharing them, and hopefully a lot of people get some benefit. And no surprise that it's going to start with tariff talk. And I'm glad it does because, again, that is the 800-pound gorilla out there for folks. And this question asks, how can we tell if the Trump administration is going too far with tariffs?
So, Tony, this is actually one of the pieces that, after I thought a lot, I'm pretty encouraged by. Tariffs are very measurable. They're also not systematic to the economy, meaning that, or structural to the economy, meaning that they're easy to take off or put back on without any negative consequence or little negative consequence. So, as much as I may not feel great about the uncertainty that we're seeing with where tariffs will lie, I can tell you I don't question whether we're going to be able to tell whether they're working or not. And so there'll be a tremendous amount of economic data that will come out in the near future. And we're really worried about not just the economy running well, but I want to see employment hold up. If employment holds up through tariffs, we'll be in a very good spot. So I would just tell that client, as much as there's uncertainty on what tariffs will look like, it's not going to be difficult to measure their effects and if they're positive or negative. and they can be taken off if need be.
That's great. Again, I think it's probably the fifth or sixth time we've probably said it, but we're going to let the data drive our decisions as well.
Mm-hmm.
This next question is an interesting one, and it's kind of odd because about midday, my 18-year-old son, who should have been focused in class, said, "Hey, my buddy Joe wants to know if this is a good time to buy some S&P 500 stocks." And of course, I said, "Well, it depends his time horizon, his goals, and things of that nature." And he's welcome to call me after school today. Focus in class, please. But this client had the exact same thought. With the market pullback, is now a good time to buy, or should I wait for a further dip?
Before I go into that answer, Tony, I will say I think this question is answered by your financial plan. I think if your plan allows you to take extra risk right now during uncertainty and you've talked about it and you understand it, then yes, this is not a bad time to be looking to invest. From an investment standpoint, not quite there yet. Yes, this is not fun, and it has historically been a really good time to be buyers when the stock market decreases by 10% from its highs. But we still think there's enough uncertainty that we're looking to be more in a risk managed mindset and making sure our portfolios are in the exact spot that we want them to be to get through this volatility. If we see the S&P 500 go down another 5 to 10%, that's generally when I think you see the fear taking over in the market, and then we can switch to being opportunistic. I think the important thing, Tony, is to have triggers and indicators to look for so that you can tell if you want to make that move. And then the next thing is it's not just a blanket we're going to buy because these indicators were hit. It's have a discussion about what is going on in the economy, in the markets, where should we take our risk, or more or less being nuanced in the approach. This is not just a blunt tool where you want to invest because corrections do snowball into recessions. We just don't think this one's going to do that.
It's a great answer, and I appreciate the insight. And this next question is really, it amazes me just how informed our clients are and how they're always just thinking forward about things. Because this question is about international stocks. And I almost relate it back to bonds, because if there was another area that's been cursed in our portfolios besides bonds over the last several years, it's international stocks. And this client, again, great insight, says international stocks have outperformed US stocks this year. Fact. Should I be moving more money to international stocks? I can't believe we're hearing that compared to the last few years, but a great thought.
And taking a step back, Tony, I'm very happy to finally start to hear that, because you have had a long period of time where international stocks have underperformed domestic stocks, and you haven't really seen a lot of reasons to get excited about investing in those markets at times. But at GreenUp, I would say it's not all or nothing here. We've been in international stocks since we've been established. International stocks are part of the index that we track. They're part of diversification. And as much as I do have a lot of excitement about the S&P 500, it would be really nice to see international stocks start to put up an argument of why we should be investing in them. So, we've kind of had a mentality of being there no matter what, and we've always had about 30% of our stock exposure in international stocks. If you're saying, should I uptick my amount? Again, I think that's very similar to the last question we had. Yes, it's good to see international stocks doing well. I'd like to see a little bit of a trend, Tony, occurring to where we can see sustainable growth before we start to get really excited about them. But I would also say, I don't think a portfolio is complete without having a portion of international stocks in your portfolio currently.
And it really goes back to 3Ds that are so crucial in investing. We've talked about diversification. You've talked about the adjustments we've made, and that's being dynamic. And the third D comes back to discipline, because we can see these rotations happening, and it's easy for us to chase the hot hand. But it's important, like you mentioned, go back to the financial plan. Look at the risk adjusted allocation that's appropriate for you and your long term goals, that's driven by the plan, and have discipline to that. And just like at the individual client level, at the firm level, and the investment committee level, we are staying disciplined to the rules-based investing approach so that we're not making emotional decisions. We are, again, letting the data drive the decision, using those disciplines to position our clients for best success, preservation, and participation both.
I don't think I could have said it better, Tony. It's a time where you really want to have a partner to just to figure out what your risk should be, and I would not be hesitating to contact that partner right now.
That's great. And I think that's a great way to wrap this up. If anyone has any questions, please, please, please reach out to your GreenUp Wealth advisor. We are here for you. As a firm, we are not asleep at the wheel. We are super in tune with what is going on in the market, but we are here for you. We recognize that these times can be challenging. And again, I want to thank these clients for submitting these questions. A bigger picture, I want to thank each one of our GreenUp clients for allowing us to be your co-pilot on this incredible journey that you have trying to accomplish all of your financial objectives. It is truly the reason we get out of bed and come to the office every day, because it is an honor and privilege to be that co-pilot for you, and we are working extremely hard. And so if you need us, we are here, and we'll certainly be in touch as well. So on behalf of Daniel Grulich, our Chief Investment Officer, and the entire staff at GreenUp Wealth Management, thank you.